It's that time of the year. Your vacation is coming up. You can already hear the beach waves, feel the warm breeze, relax, and think about work. You really, really want it all to work out while you're away. Monday.com gives you and the team that peace of mind. When all work is on one platform and everyone's in sync, things just flow. Wherever you are, tap the banner to go to Monday.com.
Welcome to another episode of Investies. I'm your host, Linda Garcia. This week on the podcast, we are going to review how the economy is doing. We have some new data that came in. We are also going to review how the markets have been performing since the downturn that we recently had on August 5th. And we also have earnings reports from Walmart and Target, which those are my favorite indicators to get a pulse on how consumers are reacting to the effects of the economy. I am recording this episode on the morning of Wednesday, August 21st. It is important for me to call out this timestamp because we are awaiting for two important events to take place, which can cause some volatility in the market from now until Friday. The first thing is that today, Wednesday, this afternoon, we are waiting for minutes from the meeting that the Federal Reserve has once a month. In these minutes, we can get a sense of what can potentially take place in the September meeting on whether or not we are going to have an interest rate hike. So we're waiting for those minutes. And then Fed Chair Powell is also going to speak on Friday. As you know, Fed Chair Powell consistently moves the market, and so we can experience some volatility from now until Friday. If you are subscribed to our Patreon account, then you will receive this episode Thursday without commercials. So if you want to check that out, head over to our show notes and we'll have a link taking you to our Patreon account. With that being said, I also want to give a very special shout out to Laura Gonzalez. Her $3 contribution a month is giving her early access to every episode commercial free, as well as a shout out here on the podcast. Laura, thank you so much. Your contribution is helping to pay our expenses on the podcast. Since we are on the topic of Fed Chair Powell, I did want to take a really quick moment to share something that is happening in my career in reference to Fed Chair. Now, if you all have been following my work closely, then you know that for the past 5 years, I have been very outspoken on Fed Chair Powell's decisions, how he's handling interest rate hikes, how he's handling the economy. And most recently, a few episodes back, I did talk about how much I respect his work. I have been following his work closely ever since he was appointed by Donald Trump. Just days after we published that specific episode, I had a political meeting with the Dallas Chamber. It was an intimate meeting. And in that meeting, I asked for data because I wanted to take a look at local regional banks in the state of Texas. I wanted to see how regional banks were being affected here. We have seen in the last couple of years, regional banks deteriorate with interest rates. And I began to speak about Fed Chair Powell and my perspective on his decisions. And the Dallas Chamber offered to host me at a meeting where Fed Chair Powell will be here in Dallas locally in the next couple of months so that I could go and listen to Fed Chair Powell speak. I completely lost all composure in that meeting. And I was so embarrassed for losing my composure. I started to get teary-eyed. I'm getting emotional now just recalling the experience because I thought to myself, what life am I living where not that long ago I was ridiculed for being a teen mom? I faced so much judgment from my teachers at the time. I was in middle school. I faced so much judgment from friends, from really close family members, from my parents. I was completely discarded from what was my safe space and chalked up as a complete failure that nobody wanted to be associated with. It could have been so easy for me to buy into that narrative. But for whatever reason, I didn't. I didn't buy into that narrative. I believed in myself and I believed in my abilities to overcome the situation that I was in. And while it was extremely challenging, and I would not wish that experience on any other young teen ever, I overcame it. And I'm getting to experience what feels like miracles to me. To me, it is a miracle, given that I had just finished the episode where I gave my respects to Fed Chair Powell, and just days later, I'm being told that I will be hosted in order to hear him speak live and in person. You could have told me that I was going to shake Oprah Winfrey's hand. I got in the car and I just started crying. We recently celebrated our 1-year mark of producing episodes consistently. And we are not currently making money from our podcast. We have faith that we will. We've acquired a partner who believes in us. I've acquired my business partners, Cosmic Standard, who I know believe in this work. I am truly passionate about the economy, and I'm truly passionate about the free markets and the accessibility that it gives us, and how understanding economics can really change our perspective. It can change the way we are hardwired and propel us into a different space when it comes to the amount of money that we are generating and how we are building generational wealth. This is real. I believe in this. And it's just wild to me that I get to, go deeper into the space and have accessibility and have resources where I get to participate and listen in real time in these rooms. And so while there's no compensation yet, and all of us on this team put in so much hard work and dedication consistently week after week, it feels like we are being told that this is worth it. These moments like this, where my political career is colliding with my passion here, talking to you all, educating you all on what I am learning, just sharing the knowledge, is so worth it to me. And I don't know where it's going to take me. I didn't know that all of this work would take me this far into a political space. I'm guessing that these experiences will continue to expand, and it's not my place to try and guess where I'm headed. It's my place to just put my head down and do the work and make sure that everything I do, I am passionate about, that I continue to receive these experiences like the one I was gifted from the Dallas Chamber, and getting to have exposure to Fed Chair Powell in real fucking time. I'm in awe. And I just wanted to share this moment with you all, because it is thanks to you all that these experiences are taking place. It is thanks to you all that I started to educate on the stock market. It is thanks to you all that I landed a book deal. It is thanks to you all that I landed the book getting translated in Spanish by HarperCollins, which you can now find in stores or on Audible. It is thanks to you all that all of these things are happening. It's a collective contribution. You all remind me how important this content is, even when I feel like no one is paying attention or no one is listening. So I appreciate your support, and I hope to continue expanding in this space, and hopefully my perspective and thought contribution can reach more folks. With that being said, I would appreciate it if you shared the podcast with friends and family. Even rating our podcast and reviewing our podcast really helps for the amplification of it. Again, thank you so much for your support. All right, let's go ahead and dive into how the market overall is currently performing. If you remember, on August 5th, we had a bottom. We dropped pretty low. The Dow went down about 8%. The NASDAQ went down 13%, which it entered correction territory. We have had a really nice rebound. I want you all to remember all of the panic that was taking place during this time, and how here we are on August 21st, and we have pretty much almost fully recovered, at least with the S&P 500. The S&P 500 is now only down 1% from its all-time high. Again, this is as of August 21st. The Dow is only down 0.8%, and the NASDAQ, which did originally take the biggest hit, is only down 4.21%. So it does have a little bit more to recover, but you guys, 4%, that is nothing. Literally, the market has pretty much fully recovered, which is a great reminder that it is important to not get emotionally tied to how volatile the market is. Last week, we received important inflation data. We received CPI. CPI data measures the change in prices paid for goods and services over a period of time. So this is what we use in order to measure inflation. Now, inflation for the month of July came in at 0.2%. This is up from June, which came in at negative 0.1%. And just to take it back a step further, in May, it came in at 0%. So we started to see a decline in May and in June. And then in July, we saw a slight tick up of 0.2%. Now, when we look at this year over year, CPI came in at 2.9%. So this means that for the last 12 months, inflation is up 2.9%. As a reminder, our goal is for inflation to be at a 2%. The 2.9% came in slightly lower than what Wall Street expected. Wall Street was expecting a 3% CPI increase, so it's good news that we came in slightly lower than expected. As a reminder, CPI data is part of the data points that Fed Chair Powell will use to determine if whether or not we are going to lower interest rates or increase interest rates. Wall Street is pricing in that Fed Chair Powell will lower interest rates in September. Fed Chair Powell has been communicative that he will not make a decision until he sees all the data points. Right now, Wall Street is anticipating a rate cut in September. You all have me on record saying since the start of this year that I do not think we are going to see interest rates come down this year. I still firmly believe this, especially with a 2.9% CPI data coming in. Believe it or not, Wall Street is like 2.9 CPI data. For sure, we're going to get that rate cut in September. For me, I'm looking at this like absolutely not. We're still 0.9% away from a 2% CPI data, which is what our target is. And because this inflation, at least to me, is proving to be extremely sticky, I am still advocating, or at least hoping, that we do not have interest rates come down, that we maintain it so that we can just be done with inflation once and for all. I might be completely wrong on this, and we may indeed see interest rates come down for the month of September. We did receive revised data that is very important to Fed Chair Powell's decision as well from payroll growth, non-farm payroll growth, which just means payroll growth from jobs that are not farming jobs. We received a very important revision on the data that is released. Month after month, there are monthly revisions, but once a year, they do an entire overhaul, make sure all of the numbers are correct, and they actually found a very big discrepancy. So we had that data come in today on August 21st. The U.S. economy created 818,000 fewer jobs than originally reported in the last 12 months period through March. So this is 30% less than what was initially reported. This is a really big discrepancy. This does let us know that the job market is not as strong as we had anticipated it to be. And remember, this is part of the information that is used to make decisions on rate hikes. I also want to note that this is the most substantial job revision that we have experienced in the data since 2009. So this is a pretty significant mistake. I want to highlight that this happened in 2009, right after we hit bottom on the housing market crash that we experienced that brought down the entire economy across the board. So I did find that really interesting. I do think that there is some correlation there. I find that to be too much of a coincidence that as we're, moving away from a bottom, we have the same discrepancy. I wonder if that's because of the amount of data that we're receiving. I don't know. It just feels a little weird. I just wanted to note that. This is future Linda stepping in here. Every single week, Eliza reviews the podcast after I record it, and she sends me back any notes if I misspoke on something. She fact checks if something needs to be reworded or corrected. And in this section here, she asks me a question. She says, Linda, as a listener, I'm wondering here if you think that the economy will crash like it did in 2008. I think I'd like you to let me know if you think that or not. This is a very valid question, given that I am leading you all to make the correlation between our last crash and what is taking place right now with the massive discrepancy in employment numbers. I'm going to answer the question that Eliza has on whether or not I think the economy will crash. I feel that it is very possible. I think that we have acquired a lot of debt, massive amounts of debt. I think that when it comes to our debt, we as a country are in trouble. However, I do not think that the trouble that we are in cannot be rectified. I think that it has to be looked at extremely closely. I think that we need to be very conservative on how we continue spending money as a country and make massive changes. We can get into our country's debt in another episode if this is something that you all would want to discuss. To keep it simple, we owe money to the Federal Reserve. We owe money to citizens that have purchased bonds. We owe money to people outside of this country that have purchased American bonds. We are in trouble when it comes to our debt. We've talked about this on the podcast before. Our GDP, how we base how much money our economy makes here in the United States, is on inflated numbers. However, I do not think it is not too late to rectify and start working towards a solution to lower our country's debt. But we need to be aggressive about doing that. I do have faith in that this will be rectified. I do think that it does require the old guards to step out of the way and develop fresh, new perspectives. I think it's also important for us to listen to old guards like Ray Dalio that are raising alarms in terms of our country collapsing. We are starting to see the early warning signs based on our lack of investing into education. But I still think, again, that we are in the early stages and that this can be rectified. I have faith that we're not necessarily going to see a crash at this moment like we did in 2008. We did already experience a market crash not that long ago. It didn't feel as severe as 2008. At least I don't think it did. Some other folks may beg to differ. But we did experience turmoil in the last several years. We're experiencing inflation. And so we're experiencing a different type of crash. I want to acknowledge that we are on the recovery side. Now, when I said that I want us to make that correlation and that I don't believe this to be a coincidence, this is me feeling a little bit of a conspiracy theory, which is why I didn't want to mention it. And I did feel like I left you all hanging when I said that. I was going to leave you hanging, and Eliza is asking me to stay accountable to what I am perceiving, and I do think that's important. I wonder if inflating numbers is done on purpose in order to lessen the blow. And if coming back and rectifying the discrepancies is also part of the responsibility that economists have. And so that was what I was hinting at when I said I feel there is a correlation, and I do not believe that the discrepancy is a coincidence. My question is, do they inflate the numbers to lessen the blow and lower the panic? Why do I think this? Because we have learned from inflation or any collapse, specifically in the 1970s, that the more fear that people heard about the news and inflation, it was a self-fulfilling prophecy. And so the fears of inflation would feed into inflation. It was causing people to go out on mass shopping sprees to acquire all of the things that they wanted to acquire before the price went up. That's how much inflation we were facing. That instead of what we are experiencing, where we are finally starting to slow down on shopping, people were buying as much as they could as fast as they can. And what was happening was that they were buying out what was accessible, which we kind of saw during the pandemic when we weren't able to get our containers from overseas and into stores. So we kind of experienced the supply and demand issue. However, in the 1970s, the supply and demand issue was that production just couldn't keep up with demand because of how much everyone was shopping. And so inflation was increasing even more because of the demand. That's what I was hinting at. Is there a possibility that we inflate numbers, make them look positive in order to lessen the fears, and then we hold ourselves accountable and fix the discrepancy once that fear is over? Now, let's get into my absolute favorite every earnings season, even though I am not invested in either of these companies. Let's take a look at how Target and Walmart performed. Walmart reported earnings last week. They actually performed very well. They beat earnings and revenue. Let's get into those numbers. Earnings per share came in at 67 cents. Versus the 65 cents that Wall Street analysts were expecting. And the revenue came in at $169.34 billion versus $168.63 billion that Wall Street analysts were expecting. So we have a close look here at the bottom line, which is 67 cents per share, and the top line, which was 169 billion. So as a reminder, earnings per share, that equals profit, and we divide the profit for every share that exists because we don't own the entire company, we own shares. And then we can multiply the earnings per share by all of the shares we own as retail investors. Some notable mentions from their earnings call is that they did grow in revenue by 5%. Most of the revenue growth came from increased website visits and also increased sales outside of their grocery department. Now, their website wasn't receiving as much traction. They were working on mitigating that. One of the ways that they did that is they did partner with Shopify to include some of the retailers that participate in Shopify onto their website. So when you search for things to purchase online, Walmart filters any retailers from Shopify. So this did draw in more visits. And then they were also struggling with sales outside of the grocery department, which was letting us know that folks just don't have money for non-discretionary items. So they weren't shopping for anything that they didn't need. They were mostly focused on groceries. Well, they did see an improvement outside of the grocery department. So that does tell us that consumers are feeling slightly more confident. Now, because of this 5% revenue increase, Walmart did overall raise its annual expectations. During earnings calls, one of the things that publicly traded companies do is give a one-year outlook, and they will either raise their outlook or lower their outlook or have their outlook remain the same. It's basically their goal, how much they want to bring in from sales or revenue for the year. And Walmart did increase their sales expectations for the year, which is really positive to see. You want to see a company do that. They didn't raise it by much, though. They just raised it by what they increased, approximately what they increased in this second quarter. Remember that we are in Q3, but the earnings that we're listening to are from Q2. The beauty of delivering earnings calls in Q3 is that we get a slight glimpse of what is happening in real time, which is why I like to listen to retail earnings, because they tell us what consumers are doing right now versus data that's a month old, like the data that Fed Chair Powell depends on. So because they increased their sales by 5%, Walmart also went ahead and raised their full year outlook by 4.75%. This means that they raised their outlook based on how well they performed in Q2. They did say that because we are in an election year and because there is unrest in the Middle East, they're not going to raise their expectations even more. They're going to keep them modest, so they don't expect any growth to take place in Q3 and in Q4. So we'll see how that all works out in next quarter's earnings call. The CFO, John David Rainey, did say on CNBC that in this environment, it's responsible or prudent to be a little bit guarded with the outlook, but we're not projecting a recession. So there's some good news there. He went on to say that the back-to-school season is off to a pretty good start. We see among our members and customers that they remain choiceful, discerning, value-seeking, focusing on things like essentials rather than discretionary items. But importantly, we don't see any additional fraying of consumer health. Target reported this morning. Let's go ahead and check out Target's numbers and how they performed in Q2. Earnings per share came in at $2.57 versus $2.18 expected by Wall Street analysts. And their revenue came in at $25.45 billion versus $25.21 billion expected by Wall Street analysts. Now, Target also beat earnings expectations. So both Walmart and Target beat earnings expectations. Something that I want to call out really quick that's a teachable moment is a lot of folks get confused when they hear about the earnings per share, because this is something that is continuously called out the most during earnings season, because it is the profit line item. It is how much money did the company make. It's important for us to know that while it can tell us how much the company made in profit, it would be incorrect to compare it from one company to the other. In other words, I can't look at the EPS from Target and make a direct comparison to the EPS from Walmart. If we were to do that, it would be easy for us to assume that Target makes a lot more money than Walmart, and that's an incorrect assumption. So just as a reminder, Target's earnings per share came in at $2.57. Walmart's earnings per share came in at 67 cents. So if we were to just compare those two numbers, we would think, oh yeah, Target's the better company. Target's the company we should be invested in, not Walmart. Well, you have to remember that every single publicly traded company has a different amount of shares that they issue out. And so the amount of shares that Target issues out is not the same amount of shares that Walmart issues out. Those are two completely different numbers. So it would be inaccurate for us to look and compare these two companies to make a decision on which one is better, simply based on EPS. If we're going to take a look at the numbers, it's important for us to also take a look at revenue. How much revenue do these companies bring in? When we look at Target's revenue is $25 billion. That is how much revenue that store brings in. And when we compare that to Walmart's revenue is $169 billion. So you can see that Walmart clearly brings in so much more revenue than Target. Now, this doesn't mean that Walmart is the better company, that's who you should be invested in. There are so many other factors that you need to take a look at when making decisions on what companies to invest in, or if you're comparing one company to the other. There's also costs and expenses. There's leadership. There is also a sentiment on how you feel about the company, how much you know about the company. I feel that even knowledge as a consumer is really important. I just wanted to take the moment to highlight that it is improper. I see this mistake all the time. It is improper to compare one EPS from the other because the amount of shares that are released to the public is different. And so that changes how we compare a company. All right, let's get back to Target and how they performed. Just as a reminder, EPS came in at $2.57 versus the $2.18 that Wall Street was expecting. Revenue came in at $25.45 billion versus the $25.21 $0.21 billion that Wall Street analysts were expecting. So they also had a strong quarter. So we have strong quarters from both of these companies that so many Americans depend on to pick up groceries from. This tells us that there is definitely a turn in sentiment in terms of how folks are spending money. Now, remember, just a few episodes ago, we talked about how both Target and Walmart were aggressively lowering prices because they started to see their revenue drop. So they needed to do everything they could to get consumers back in stores. Target dropped prices on 5,000 frequently bought items, while Walmart dropped prices on 7,200 frequently bought items. However, Target's sales increase wasn't as high as Walmart's 5%. Target sales increased by 3%. This is a big win for Target. Even though it's not as big as Walmart, we got to remember that Walmart is just a bigger store overall. It drives in more revenue. Target returned to growth for the first time in 5 quarters. For 5 consecutive quarters, Target was posting a loss. And so this is the first time that they have seen an increase in sales. So this was a big win for Target. They kept their full year outlook the same, which I think is really smart. You know, that's not a big enough increase to increase their outlook. They want to be precautious, and I think that's good. They also worked on executing other strategies to increase sales and deepen loyalty. We already talked about lowering prices, which is really important, but they did do a relaunch of their Target Circle 360, which is a membership loyalty program. And they also went ahead and competed with Amazon's Prime Day. So they launched a really big campaign in hopes to take away some of Amazon Prime Day's traffic and bring it over to Target. We did see the market react positive to both of these beats. Target, after reporting earnings, saw a 15% increase. 15% is how much that stock increased after reporting its earnings. And from Walmart, they reported last week, we have seen a 9.4% increase. So both significant increases on the stock. Now, all in all, what this tells me is that we are seeing a turnaround, that the drop in prices have definitely helped consumers and have made consumers feel a little bit more comfortable in the stores, increasing in their purchases. So this is positive. This type of data would lend itself to the potential of Fed Chair Powell lowering interest rates. Again, I still think it's too early, it's too soon. We still need for Walmart and Target to continue lowering their prices. I would like to see inflation come down a lot further than where it is currently. I do want to praise that Fed Chair Powell got us down to 2.9%, which is something that is very hard to do, but I definitely want to see it come down even further, because when we start to look at inflation on a case-per-case basis, meaning not looking at just the average of inflation, and we start to look at items, inflation starts to look very different. To put this into perspective, for July 2024, the year-over-year increases in specific items are as follows. Juices and drinks, 19.2% increase in price. Eggs, 19.1% increase in price. Frankfurters, which is like hot dogs or anything that is encased, any meat that is encased like sausages, 9.7% increase. Bacon, 8.5% increase. Beef roast, 7.5% increase. Butter, 6.1%. Baby food, 6%. Carbonated drinks, 3.9%, which apparently is different from juices and drinks. Fresh chicken, 3%. We start to see it drop there. And then when we look at items that do not include food and energy, We're looking at motor vehicle insurance, 18.6%. I know I am definitely feeling that one. We are actively looking right now to lower our car insurance and moving over from our current provider. You have photographic equipment and supplies. The increase is 12.6%. Indoor flowers, 10%. Care for elderly folks, 9.8% increase. Admission to sporting events, 8.8%. So you can see here that once we start looking at individual items, this is still relatively high. It is still eating at our expenses. And so it's important to take all these things into consideration. That's it for this week's episode. You're listening to Investies, a Cosmic Standard and In Luz We Trust production. I'm your host, Linda Garcia. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.